At 2 p.m. on an ordinary weekday, a short statement drops online. No sirens. No election. No referendum. Just a few lines: rates will remain, or policy is tightening, and within seconds. Your mortgage becomes more expensive. Your savings earn less in real terms. Businesses freeze hiring. Markets either exhale or panic. And here's the strange part: the people whose lives get rearranged the most weren't in the room. Money feels like the weather, something that just happens. But money isn't weather. Money is architecture. And some of the most important blueprints were drawn in rooms so small you could count the chairs. Tonight, we follow the pattern: crisis, closed doors, new rules, everyone adapts. Before modern banks, trade had a brutal enemy: bad money. Coins weren't just different weights, many were shaved, weakened, faked, or quietly improved by rulers who needed quick cash. Merchants didn't argue about philosophy. They needed a system that worked tomorrow morning. So in the late 1500s, in a world of maritime trade and constant currency chaos, Venice did something radical: it created a public bank designed to turn messy metal into clean accounting. Not a dramatic revolution in the streets. More like a technical decision in the back office of empire. Depositors could place coin and settle transactions through ledger entries, numbers on a page that carried more trust than the coins themselves. That idea is a turning point that doesn't sound like one. But it is. Because once money becomes an entry, whoever controls the ledger controls the bloodstream of trade. And that control rarely lives where the crowds are. Fast forward to the 1600s. Europe is wired with war. States need cash constantly, but taxes arrive slowly and rebellions arrive fast. Then another quiet invention appears: central banking tied to government finance, a system that can fund emergencies today and push the bill into the future. In Sweden, the Riksbank emerges from financial turmoil, becoming one of the earliest examples of a state-linked bank that helps stabilize and finance a growing economy. This isn't just about stability. It's about a new political technology. The ability to borrow at scale, again and again, without the whole system collapsing immediately. Once governments discover that tool, they don't unlearn it. And once investors discover they can earn from the state's need, they don't unlearn that either. The modern world quietly moves from money as metal to money as policy. Now jump to France, 1800. The country is battered by revolution, war, and instability. Napoleon rises, not just as a general, but as a builder of institutions. One of the most powerful creations of his era wasn't a battlefield win. It was a financial lever, the Banque de France. A country can have flags and laws and armies, but if credit is broken, everything else becomes fragile. So a new center forms, part public, part private, operating at the core of state finance. And the deeper lesson is timeless. Empires don't run only on ideology. They run on reliable borrowing, controlled liquidity, and disciplined trust. Those are not crowd-made systems. They're engineered systems. Then we arrive at the famous American chapter, the one that feels like a thriller. In the early 1900s, the United States is exploding in industrial power, but banking is unstable. Panics are frequent. Trust breaks easily. After the panic of 1907, the elite fear the same thing the public fears: collapse. But they draw a different conclusion. The public sees, Wall Street is dangerous. The architects see, we need a central mechanism. So in 1910, a small group travels to a private retreat, Jekyll Island. They don't announce it as, let's redesign American money. They wrap it in normalcy, in discretion, in plausible deniability. What matters isn't the gossip of secrecy, it's the reality of how systems get built. A crisis creates urgency. Urgency concentrates decision-making. And concentrated decision-making creates institutions that last. A few years later, America gets the Federal Reserve System, a structure designed to be insulated from daily politics, yet powerful enough to influence credit, rates, and liquidity across the entire economy. Whether you consider that wise, dangerous, or inevitable, it becomes the template for modern monetary governance. Let's skip the Grand Conference Hall story and go somewhere more revealing, the Plaza Hotel, 1985. By the mid-1980s, the US dollar is strong, too strong. It's crushing American exports and reshaping global trade. So what happens? Not a global vote. Not a public debate across 5 countries. Finance ministers and central bankers from the largest economies meet and coordinate a plan to push the dollar down. The result becomes known as the Plaza Accord. This is a key modern pattern. Even in a world with cameras everywhere, the most consequential monetary shifts often begin as coordinated understandings among a small circle, then ripple outward into jobs, prices, and asset values. A hotel meeting becomes a worldwide economic event. If you want to see how power behaves, watch what happens when time runs out. In financial crises, decisions don't move through public rituals. They move through phone calls, closed meetings, and weekend marathons. 2008 is a masterclass in this. As markets seize up, rescue programs, guarantees, emergency lending facilities, mechanisms most citizens had never heard of, appear almost overnight. Again, you can argue these actions prevented catastrophe. Many economists would. But the structural point remains. When the system is burning, the people with the tools meet first, decide first, and explain later. And once those emergency tools exist, they rarely disappear. They become part of the permanent toolkit. Today, monetary coordination doesn't always look like a secret society. It looks like technical committees, policy symposiums, working groups, closed-door briefings, off-the-record discussions that later become the official direction of the world economy. Central bankers still gather regularly in Switzerland under the umbrella of international cooperation. Finance ministries still coordinate during stress. Markets still hang on tone, wording, forward guidance, signals that most people never notice until their loan payment changes. And now we're entering the next era. Programmable money. Central bank digital currencies. Instant settlement. Identity-linked payment rails. If that future arrives, it won't arrive because a crowd asked politely. It will arrive because a small number of institutions decide that the plumbing must evolve, usually in the name of stability, security, and efficiency. Maybe they'll be right. But history shows the trade-off is always the same. Convenience for the many. Control for the few. So what's the takeaway? Not that everything is a conspiracy. That's lazy thinking. The real takeaway is more unsettling, and more useful. Money is not neutral. Money is a design choice. And design choices reflect the priorities of the designers. Sometimes those priorities include stability. Sometimes they include survival. Sometimes they include advantage. And the pattern is durable. A system breaks. The most equipped people meet privately. A new framework is produced. The public experiences it as reality. Once you see that, you stop being shocked when the rules change. You start preparing like someone who understands the game. Avoid betting your entire future on one currency, one asset, or one institution. Assume incentives matter more than promises. Treat temporary measures as potentially permanent. And recognize that financial freedom starts with understanding who writes the rulebook. Because the greatest trap isn't poverty. It's surprise. And history doesn't punish you for what you don't believe. It punishes you for what you never bothered to learn. If you want the next episode, subscribe, because the blueprint isn't hidden. It's just buried under the noise. And we're going to dig it up.